On Friday, July 11th, 2025, the mood on Wall Street was electric with anticipation. Investors and traders, buoyed by weeks of steady gains, were looking forward to another day of growth. But that optimism was about to be shattered by a single seismic announcement from Washington, D.C., one that would send shockwaves through the financial world and leave even the most seasoned market veterans reeling. In a hastily arranged press conference, President Donald Trump stood before the nation and declared a potential 35% tariff on all Canadian imports, set to take effect August 1st. The news was delivered with characteristic bravado, but the implications were anything but routine. This was not just another policy tweak or negotiation tactic. It was a bold, direct challenge to one of America's closest trading partners, and a move that threatened to upend decades of economic cooperation. The announcement landed like a thunderclap. Within minutes, trading floors across the globe erupted in confusion and disbelief. Stocks began to plummet as investors scrambled to make sense of the new reality. The global economy, already on edge from recent trade tensions, was suddenly staring down the barrel of a full-blown crisis. The financial community, still digesting a smaller tariff on Brazil announced just the day before, was blindsided. Many had assumed that the Brazil move was an isolated incident, a warning shot perhaps, but not a prelude to something bigger. Now, with Canada in the crosshairs, it was clear that no trading partner was safe from sudden policy shifts. The market's confidence, so carefully built over months of steady growth, evaporated in an instant. Anxiety replaced optimism as investors watched the Dow Jones and other major indices tumble. The fear was palpable, not just of immediate losses, but of what this might mean for the future of global trade and economic stability. Investors who had grown complacent, lulled by years of relative calm and predictable policy, were suddenly forced to reconsider their positions. Portfolios were rebalanced, assets were sold off, and safe havens like gold and government bonds saw a surge in demand. The sense of uncertainty was overwhelming. The threat of a trade war with Canada, a key partner in the US-Mexico-Canada agreement, and a country with deep economic ties to the United States, was a wake-up call. Businesses on both sides of the border began to assess the potential fallout, from rising costs to disrupted supply chains and lost jobs. The market's reaction was swift and unforgiving. Fear of rising costs, supply chain chaos, and a new era of uncertainty gripped investors. Companies that relied on cross-border trade faced immediate questions about their future, and economists warned of ripple effects that could reach every corner of the global economy. The events of that day were a stark reminder. Political decisions, especially those made at the highest levels, can upend financial markets in an instant. No algorithm or forecast could have predicted the speed or severity of the market's response. As the closing bell echoed through an eerily quiet trading floor, it was clear the party was over. The cleanup had just begun, and the world was left to wonder what the next chapter in this unfolding drama would bring. When the closing bell rang, Wall Street was awash in red. The Dow dropped 279 points, ending a strong run and signaling a sharp reversal in sentiment. The S&P 500 and Nasdaq also fell, snapping multi-week winning streaks. The losses weren't catastrophic, but the psychological blow was real. Investors were reminded that markets are cyclical. Growth can quickly give way to contraction. The tariff news flipped the switch from risk-on to risk-off in a matter of hours. The red numbers reflected more than data. They captured the fear and uncertainty gripping investors. For now, optimism had given way to doubt. Let's break it down. Tariffs are a word you hear tossed around a lot in the news, especially when countries are in the middle of heated trade negotiations. But what exactly is a tariff, and why does it matter so much to businesses, consumers, and even the stock market? At its core, a tariff is simply a tax that a government places on goods coming into the country from abroad. Think of it as a fee that importers have to pay when they bring in products from other nations. For example, when President Trump threatened to slap a 35% tariff on goods from Canada, it meant that American companies buying Canadian products would suddenly face much higher costs. That 35% isn't just a small bump. It can make a huge difference in the price of everything from cars to groceries. Companies facing these new costs have a tough choice to make. They can either absorb the extra expense themselves, which eats into their profits and can make it harder to invest in new projects or hire more workers, or they can pass those costs along to consumers, which means you and I end up paying more at the store for the same products we used to buy for less. When prices go up, people often buy less. That means companies might see their sales drop, which can lead to lower earnings, layoffs, or even store closures in extreme cases. But tariffs don't just stop at one country's border. When one nation imposes tariffs, the other country often retaliates with its own taxes on imports. This back and forth can quickly escalate into a trade war, where both sides keep raising barriers, making international trade more expensive and complicated for everyone. For multinational corporations that rely on global supply chains, tariffs can throw a wrench into carefully planned logistics. Suddenly, parts and products get delayed, costs go up, and companies have to scramble to find new suppliers or routes. Investors pay close attention to these developments. To them, a tariff isn't just a tax. It's a signal that profits might shrink, consumer prices could rise, and other countries might hit back with their own tariffs, making things even worse. The one thing markets dislike more than anything else is uncertainty. When tariffs are announced, no one knows exactly how companies will respond, how consumers will react, or how other countries will retaliate. This uncertainty makes it hard for investors to predict future earnings. When there's doubt about profits, stock prices often take a hit, as investors rush to sell off shares and avoid potential losses. That's why, when big tariffs are announced, you'll often see the stock market react with panic. Investors hate surprises, especially ones that threaten the bottom line. The impact of tariffs goes far beyond just the companies that import goods. It can ripple through the entire economy, affecting jobs, prices, and even the health of entire industries. Factories might close, workers could lose jobs, and communities can suffer. So the next time you hear about tariffs in the news, remember, they're not just about taxes. They're about the complex web of global trade, the health of our economy, and the financial well-being of millions of people. That's why tariffs matter. The Magnificent Seven, Amazon, Alphabet, Apple, Meta, Microsoft, Nvidia, and Tesla, hold enormous sway over the market. As of July 10th, these seven made up nearly a third of the S&P 500's value. Their size means their stumbles drag the whole market down, even if smaller companies are doing fine. Recent market gains were driven by just a handful of these tech giants. When the tariff news hit, these companies, deeply reliant on global supply chains and international sales, were hit first and hardest. The market's dependence on so few players is a vulnerability. The July 11th drop showed how quickly the market can fall when its leaders falter. When giants stumble, the shockwaves are felt everywhere. The lessened market concentration magnifies risk. Among the Magnificent Seven, Nvidia has emerged as the true standout, capturing the attention of investors, analysts, and tech enthusiasts alike. Its journey from a niche player to a global powerhouse is nothing short of remarkable, and its influence now stretches far beyond Silicon Valley. Once known primarily for its high-performance gaming graphics cards, Nvidia has reinvented itself as the backbone of the artificial intelligence revolution. Its specialized chips are now the beating heart of data centers, powering everything from self-driving cars to advanced medical research and enabling breakthroughs in machine learning that were once thought impossible. On July 10th, Nvidia achieved a historic milestone, becoming the first company ever to reach a staggering $4 trillion market cap. This achievement not only cemented its place among the world's most valuable companies, but also sent shockwaves through the financial world as investors scrambled to get a piece of the action. The company's meteoric rise has been nothing short of breathtaking, lifting the entire stock market along with it. As Nvidia's fortunes soared, so too did the hopes of investors, with its success fueling a broader rally in tech stocks and driving optimism across Wall Street. But this extraordinary concentration of market power is a double-edged sword. While Nvidia's dominance has brought prosperity to many, it has also introduced new risks, making the market more vulnerable to sudden swings in sentiment and performance. When Nvidia's stock price soars, the entire market seems to follow in its wake. But when the company stumbles, even briefly, the ripple effects are felt far and wide, sending shockwaves through portfolios and indices alike. The recent threat of tariffs put Nvidia's dominance into sharp perspective. It served as a stark reminder that no company, no matter how valuable or innovative, is immune to the unpredictable forces of global politics and trade tensions. The market's swift and sobering reaction to the news was a reality check for those swept up in tech euphoria. It highlighted just how quickly fortunes can change, and how even the most celebrated companies are subject to forces beyond their control. Even the undisputed king of AI cannot escape the consequences of political decisions made half a world away. The delicate balance between innovation and international relations is always in play, shaping the destiny of tech giants. In the end, the crown of tech royalty is heavy, especially when the fate of global trade hangs in the balance and every move is watched by the world. While stocks fell, the VIX, the market's fear index, remained surprisingly low at 16. This suggested investors weren't panicking, just cautious. Meanwhile, Bitcoin surged above $118,000, defying the usual risk-off playbook. Normally, fear drives investors to safer assets, not volatile ones like crypto. The mixed signals, falling stocks, calm VIX, rising Bitcoin, showed a market uncertain, not terrified. Some investors rotated into new assets, others held steady, betting the dip was temporary. Beneath the headlines, there was debate. Was this a crisis or just a pause? The answer wasn't clear, but the uncertainty was real. Enter the taco trade. Trump always chickens out. Some investors bet that Trump's tariff threats are just negotiating tactics, not real policy. They see market dips as buying opportunities, expecting a last-minute deal. This strategy has worked before, but it's risky. Political calculations are unpredictable. If the bluff is called, losses could be severe. Betting on a bluff is high-stakes poker with your money. Not everyone buys the taco trade. Analysts like Sarah Bianchi warn that this time could be different. With markets at record highs, the administration might feel emboldened to follow through on tariffs. The debate splits experts. Optimists see a temporary dip. Pragmatists see real danger. The market's narrow leadership makes it fragile. Tariffs could signal a lasting shift in global trade policy. The advice: hope for the best, but prepare for the worst. Complacency is the real risk. Why does all this matter? Because it's your money on the line. Market swings affect your retirement, college savings, and investments. Understanding tariffs and market concentration helps you make smarter decisions. Don't panic or try to time the market. Focus on diversification and long-term planning. Build a portfolio that can weather shocks. Stay informed, stay engaged, and don't let fear dictate your actions. The market is a powerful wealth-building tool, but it's never a smooth ride. Knowledge is your best investment. Use it to secure your financial future.